All right, the Chapter 14 Statement of Cash Flows follows the activities that a for-profit business is involved in. If you recall from the very first chapter, we said that businesses have three types of activities. They operate, so there's operating. They invest, and they finance. So we have operating, investing, and financing types of activities. Well, the statement of cash flows is the only statement out of the four that actually follows that guideline, that structure. So this is one of the most important financial statements to go through and fully analyze a company. There are two ways of doing a statement of cash flows. There are direct and indirect. The difference between them is only affects the operating section. The investing and the financing section on both the direct and the indirect are identical. So the only thing that changes is how do you calculate, go through the steps to calculate net cash flows provided from operating activities. All right? In this class, we're only going to focus on the second one. We're only going to focus on the indirect method. Now, your chapter goes over the direct method. The reason we focus on the indirect method is overwhelmingly, companies in the United States use the indirect method. Now, having said that, internationally, the indirect method isn't allowed. So this is only available under U.S. GAAP. Only the United States produces statements of cash flows using the indirect method, and overwhelmingly, companies use them. All right? So, let's do some examples and show you what the differences are. We'll start simple. Exercise 14-17 on page 678. So exercise 14-17 on page, what did I say? 678. In this one, a comparative balance sheet of Pelican Joe Industries for December 31st, 2016 and 2015 is as follows. And they have various assets, liabilities, and stockholders' equity for the 2 years. And the numbers are simple. They're only in hundreds to make the math easy. All right? As always, there's a 3-line header, so it would say Pelican Joe Industries, Inc. Statement of cash flows is the second line, and this is just like the income statement and just like the retained earnings statement. This measures activity. So once again, it is for the year ended December 31st, 2016. We start with cash flows from operating activities. Under the indirect method, this section begins with net income. I'll just stop there and say the indirect method begins with net income and is then going to make a series of adjustments to reconcile net income to cash flows. All right? The direct method calculates proceeds from and outflows to. All right? So proceeds from could include, and this is just operating activities. So it includes cash receipts from customers, cash receipts from other renters, things like that. Outflows include cash outflows for payroll, cash outflows for inventory, cash outflows to other suppliers, things like that. All right? So where is the money coming from and where is the money going? I overwhelmingly prefer this method because it directly ties in the income statement. And we go from there. All right? So if you look at this problem on page 678, the financial statements here, every change in every account on the balance sheet is going to be included in this statement of cash flows. Every line item. Plus some line items from the income statement. And they give you those items over here on the next page on 679, and there are 6 of them. One of which, it says, there was a $325 credit to retained earnings for net income. So net income was $325. Then we make a series of adjustments. To reconcile net income to net cash flows from operating activities. All right? So adjustments to reconcile net income to net cash flows from operating activities. The first ones are non-cash items that are in the income statement. So items that, are either non-cash or non-operating. Okay? So I'm going to go ahead and write that up, even though your textbook doesn't, but I'll put it in here. Non-cash or non-operating. So what's a non-cash expense? What's an expense? Payroll is cash. Utilities are cash. All of the selling and general and administrative expenses are cash. The exceptions are depreciation, amortization, and depletion. Those are expenses associated with long-term assets that we expense out over a period of time. There's no cash involved. The cash was involved when you invested in those items. That's when you spent the cash. All right? Now you're just expensing it. So depreciation is always a non-cash. And in that list of 6 items, there was $30 in the income statement associated with depreciation. It was item number... Where is it? Oh. It says there were no disposals of equipment during the year in item number 3. It says no disposals. So if you look at the accumulated depreciation in 2015 was $30, and it went to $60. So that's the $30 worth of depreciation. So there was $30 worth of non-cash expense in depreciation. The second thing that it says in here, on the very top, the first additional information at the top of page 679, it said land was sold for $125. Well, if you sold land, and you'll see in the land item on the balance sheet, that land went from $450 down to $400. So you sold $50 worth of land, because that's the reduction in the land equipment. It went from $150 down to $100. If you sold $50 worth of land, or it went from $450 down to $400, for $125, you had a gain on sale of land. For $75. Okay? So the land equipment went on 12/31/16, it was $400, and on 12/31/15, it was $450. And then it says land was sold for $125. All right? So if land went down $50, that was the basis, that's what you purchased that land for, $50, and you sold it for $125, you had a gain. And that's a negative non-operating adjustment because the gain increased net income. So you need to back that back out. So that's all the non-cash, non-operating in this particular example, was those two items. The second set of adjustment are changes in current assets and liabilities. Changes in the current assets and liabilities section of the balance sheet. Starting with the current assets. And they've only got two. They've got accounts receivables and they've got inventory. Because remember, current assets are cash, what you're going to turn into cash, what you're going to sell, and what you're going to use up. So they only have two. Accounts receivable went up. It was $200 and it went to $280. So if accounts receivable went from 200 to 280, we have an increase in accounts receivable. So if accounts receivable went up, what did that do to cash? If your accounts receivable, the amount your customers owe you, increases, what are your customers not doing? Are they paying you? No. Because if they were paying you, the balance would go down, right? You'd have a decrease in accounts receivable. So the fact that the accounts receivable balance went up means that your cash balance went down. So that is a negative adjustment of $80. So current assets have an inverse relationship to cash. All right? Accounts receivable went up, which means that cash went down. Inventories, on the other hand, went from 110 to 175. So inventories also increased. So if you have $65 worth of more inventory, you spent cash on that. That also is a negative adjustment. Actually, go ahead and put all this under one. So 80 and 65. That's it for current assets. Current liabilities only has one. They have an accounts payable to their merchandise creditors. It went from 160 to 175. So accounts payable started the year at 160, and it went up by $15. So if your accounts payable is going up, what are you not doing? Just like your customers, you're not paying your bills either. All right? Because you now owe more money to your creditors, your merchandise creditors. So this is an increase in accounts payable. That's a positive adjustment. There's a direct relationship between current liabilities and cash. Because if you're not paying your bills, you're saving cash. It's not sustainable. I know you guys as college students are tempted to do that on frequent occasions. But that's not something you can do for very long. But you can save all sorts of cash by not paying anybody. All right? You just can't do it for more than a month or two. So then they'll start knocking on your door. They'll cut your cell phone off. Your car will disappear in the middle of the night. There's all sorts of bad things that happen. That's it for the operating section. If you add all this up, you get net cash flows from operating activities. And in this case, all of that adds up to 150. Now, I'll caution you. All of these here are kind of grouped together. All of the non-cash, non-operating adjustments, all of the adjustments for current assets and current liabilities, they're all kind of down here in this section, one after another. This net income is up here kind of by itself. What I see repeatedly on exams, the final exam, is for students to add up all this and forget the net income. Don't do that. All right? It's all of the numbers. All right? That's the first section. The next section is investing activities. Investing activities is the rest of the asset side of the balance sheet. Any net changes other than the current asset section, because we've already accounted for that in the operating activity section. So land, we've already talked about. It went from 450 down to 400. So the cash received, because we already took the gain out of the net income part, so now we have cash received from sale of land. And they told us that was $125. So that was the change in the land account. Equipment went from 175 to 225. And item number 2 on the additional information, it said that equipment was acquired for cash. We didn't borrow the money to buy the equipment, we paid cash for it. So we have cash paid for equipment. And that was $50. And that's it for investing activities. That's it for the rest of the asset side of the balance sheet. Because the only other account that's on the balance sheet was the accumulated depreciation, and we also accounted for that back in the operating activities. So if you add these two numbers together, you get 75, which is net cash from investing activities. That leaves us our last and final section, cash flows from financing. This is the last part of the balance sheet. The only thing we haven't yet accounted for is the rest of the liability, the long-term liability section, and then all of the stockholders' equity section. All right? So, in here, we have no long-term liabilities. We have common stock, which went from $50 to $100. And then the paid-in capital in excess of par went from $125 to $250. So combined, there is $175 worth of 175, which is cash received from sale of common stock. So common stock we sold $175 worth. The last item in the liability section there is dividends payable. And it tells us up here, well, it also told us in item number 4, common stock was issued for cash. And then the last thing was there was a $100 debit to retained earnings for cash dividends declared. So if we declared $100 worth of dividends, because this is the last thing, is cash paid, for dividends. So if we declared $100 worth of dividends, but we still have 30 of it that is owed to the shareholders, to the common stock shareholders, how much did we pay in cash? We declared 100, and we still owe 30 of it. $70. That means we had $105 is net cash flow from financing. If you add up the $150 that came from operating activities, the $75 that came from investing activities, along with the $105 from the financing activities, you get an increase in cash of $330. And sure enough, cash at 12/31/15 was $160, and cash at 12/31/16 at the end of the year was $490. And that is the indirect method of the statement of cash flows. Questions on this? 3 sections representing the 3 activities for for-profit businesses. Operating, what they do day in and day out. Investing, where do they put their money to work long term? And how do they pay for all of it? Financing. Now, the final exam is take-home. I mentioned that earlier. So, at 8 a.m. Monday morning, there's a tab on the left side of your Blackboard site right now. 8 a.m., that tab is currently blank. There's nothing in it right now. The final exam template, which is an Excel template with 3 questions in it, will appear. You download that. You have until midnight Wednesday in order to complete the 3 problems. There's a problem on bonds that I went over last week, and I'm going to post that video here today or tomorrow, along with the video that I'm doing right now. You got to go out and price the bond using the Appendix A, then amortize the premium or the discount, whether it sells for more or less than its face value, over the 5-year period, and in order to determine how much the interest expense is on an annual basis. All right? So the effective interest rate method of amortizing the premium or the discount and the calculation of the proceeds of the bond. The statement of cash flows, I will give you a summarized income statement and a balance sheet. And then you do this, the indirect method. And it's open book, so there's lots of examples, and you've got 2 full days to do it, 3 full days to do it in. There's plenty of time. And then lastly, I will give you a very summarized download for financial statement analysis, the Chapter 15. So I go out and I pick a publicly traded company. I give you a comparative balance sheet and an income statement for that company, and you do the 10 ratios. There's no horizontal or vertical analysis like the extra credit. You just do the 10 ratios. So how much working capital do they have? What is their current ratio, their quick ratio, both the days for accounts receivable and the turnover and the inventory turnover and number of days in inventory, days sales and inventory, and those 10 ratios. Same 10 as from the extra credit. And there's videos for that online to walk you through how to do all that. Okay? All right, let's do problem number 1, problem 14-1A on page 682. I'm going to leave most of this up here. So problem 14-1A on page 682. The comparative balance sheet of, Cromie Inc. God bless you. God bless you. December 31st, 2016 and 17, it shows as follows, and then once again, they've given us 6 items of additional data that was from the accounts. All right? And so it's a little bit more complex, but anytime you're approaching a problem such as this, and in the final exam, I mean, you're given an Excel spreadsheet. So the first thing you're going to do is get the change, either an increase or decrease, on every account on the balance sheet. So subtract the previous balance from the current balance and see whether or not did cash go up, did accounts receivable go down, what happened to inventory, what happened, in this case, they've got investments, they've got land and equipment, they've got accounts payable, they've got accrued expenses payable, a dividend payable, common stock, paid-in capital, and retained earnings. So get the net change of every item on the balance sheet. And then look at the additional information, because you're going to start with net income. And then it says here in item E, there was a credit of $199,540 to retained earnings for net income. So let me get rid of all the numbers here. And I'll be able to save most of that. So net income in this case was $199,540. So then you have adjustments to reconcile net income to net cash flows. So non-cash or non-operating activities. Once again, accumulated depreciation, and it says in here that equipment and land were acquired. There were no disposals of equipment during the year. So all of the changes in accumulated depreciation, which went from $148,000 to $166,400. So accumulated depreciation changed by $18,400. That's a non-cash expense that lowered net income. So you need to add that back for that reconciliation to cash. All right? Then it also said in here the investments were sold for $280,000 in cash. Well, if you look at the investment account, it started the year at $240 and ended the year at $0. So we had some investments. Doesn't say whether they were marketable securities or bonds, or even if it was a whole other company. some sort of investment, which was originally purchased for $240,000, was sold for $280,000. So we had a gain on sale of investments. Of $40,000. We can also go ahead and put up here, under the activities, investing activities, the cash proceeds, which told us was $280,000. Because we sold all of them. We liquidated all of our investments in exchange for $280,000 in cash. That's it for the non-cash or non-operating. We then go through and look at the net changes of current assets. Accounts receivable went from $242 down to $224,600. So we had a decrease in accounts receivable. Of $18,880. Oh, I'm sorry. Hold on. Oh, I'm looking at the wrong one. It went from $208,960 to $227,840. That is an increase, not a decrease. I read the wrong problem. I was looking at problem 2. So if it went up, your customers are not paying you. Inventories went from $617,120 to $641,760. It also went up by $24,640. So the math is more complicated here, but the theory is the same. There is an inverse relationship between current assets and cash. Any changes in current assets, if it goes up, cash goes down. If a current asset goes down, cash goes up. All right? Current liabilities, accounts payable, went from $404,000 up to $424,000 and change. That also was an increase in accounts payable, $19,520. There's a direct relationship between current liabilities. If they go up, you're not paying people, so cash goes up. And then there is a decrease in accrued expenses. So this could be accrued taxes, this could be accrued interest, this could be almost anything. So they went up $10,400. That's a negative adjustment to cash. All right? Add all that up, including the $199,540 worth of net income, and you have a positive $143,540. That is net cash flows from operating activities. And when you're looking at a company, you always want that to be positive. You want their day in, day out existence, what they do in the morning when they get up, to throw off positive cash. That's a warning sign if that's negative. All right? Okay. Other long-term assets. Everything except current assets. We had the investments that went to zero, but we've already recorded that. Cash received from sale of investments, $280,000. Land went from zero to $328,000. So we have cash paid for land. And we paid $328,000. And that's a use of cash. And it told us here in item B, equipment and land were acquired for cash. Equipment went from $553,120 up to $705,120. So cash paid for equipment was $152,000. If you add all that up, we have a negative now, $200,000. So this is net cash flow used. For investing activities. So rather than the old one which said net cash flows from investing activities when it was positive, when it's negative, it's net cash flows used for investing activities. Okay, once again, we have a dividend payable that went from $19,200 up to $24,000. And it tells us in item F, there was a $96,000 debit to retained earnings for cash dividends declared. So the cash that we paid for dividends was $91,200. That's the difference between the $96,000 in cash dividends declared and the net change in the dividend payable of $5,800. So $91,200 of it was paid in cash. And then lastly, in item D, it said common stock was issued for cash. The common stock account went from 100 up to 150, and the paid-in capital went from 280 up to 417,500. So in net, they sold 187,500. Add those two together, we have a positive 96,300, which is net cash flows from financing activities, because it's a positive. If you add up the 143,500 positive net cash flows from operating activities to the negative net cash flow used for investing activities and the positive net cash flows from financing activities, cash increased by $39,840. Cash at the beginning of the year at 12/31/2015 was $585,920, which gave us $625,760 as cash at the end of the year. And that should give you enough to be able to do the final exam.